You do not need $1,000 to start investing. You can begin with just $5. This is not a motivational slogan, but a factual statement about how investing works in today's world, shattering the myth that investing requires substantial initial capital. Somewhere along the way, people were led to believe that investing is reserved for wealthy individuals and institutions, a notion that was once true but no longer applies. The disparity between this misconception and reality can cost regular individuals significant years of potential growth they will never recapture. So let's get started. Step by step. No hype, no secret tricks, no urgency. Just a clear guide on how someone with almost no spare money can begin putting that money to work, what it actually looks like in practice, and where the real risks lie. Stick around because the last step is often overlooked, and it's crucial for determining whether your efforts will succeed. Let us start by debunking the biggest myth: small amounts of money are worth investing. The idea that you might as well not bother if you can only spare $10 or $20 is misguided. This notion is dangerously wrong. Because what a small investor has that even large investors covet is time. And time is the engine that drives growth in investments. Here's why: when you invest, your money earns a return. Historically, a broad basket of the largest companies in the United States, as measured by indices like the S&P 500, has returned around 10% per year on average before inflation and closer to 7% after accounting for rising prices over long periods. Now that is an average across decades. Some years it can rise by more than 30%, while others may see declines of up to 20%. It's bumpy, and anyone who tells you otherwise is selling something. But over extended stretches, this average acts as the gravitational pull that lifts wealth upward. Now watch what that does over time. Say you invest $100 and earn 7% in the first year. Next year you do not just have your original 100 plus 7, you have the growth on the growth. Year 2 you earn 7% on $107, not just on $100. That extra bit is small. Almost insulting at first glance. But it compounds. It feeds on itself. Run that forward 30 or 40 years, and the curve does not go up in a straight line. It bends upward steeper and steeper like a plane taking off. That bend is called compound interest, and it is one of the most powerful mathematical concepts for growing wealth over time. But here is the part that matters for you specifically. Compounding rewards time far more than it rewards size. A person who invests $50 a month starting at age 25 will very often end up with more money at retirement than a person who invests $200 a month starting at age 40. The late starter puts in far more cash. The early starter wins anyway, because those extra 15 years let the growth stack on itself for longer. So when you say you only have a little to invest, you are actually holding the most valuable ticket in the building. You just have to punch it early. Okay. Theory over. Let's get practical. Step 1 is essential, even though many dislike it. Skipping this step often leads to financial mistakes. Before you invest a single dollar, look at your situation honestly. Do you have high-interest debts? Credit card debt in particular, often charging interest rates of 18%, 20%, or even higher, can be especially detrimental. If you do, that debt represents the best and worst investment you will ever find. Paying it off is a guaranteed return equal to that interest rate. No stock market consistently offers a guaranteed return of 20% or more. So if you're carrying a balance at those high rates, mathematically, paying off that debt usually beats investing, because you earn the equivalent of that rate risk-free just by eliminating your debt. That is not me telling you what to do with your money, it's simply presenting the arithmetic involved. Second part of step 1, do you have any cushion at all? A small emergency buffer, even a few $100s sitting somewhere you can reach quickly. Because without one, here's what happens. You invest your last $100. 2 weeks later, your car dies or your tooth cracks. Now you are forced to pull that money out at the worst possible time, perhaps when the market is down, and you lock in a loss and may learn to hate investing forever. A small cash cushion allows you to leave your invested money untouched through turbulent times. And leaving it alone is essentially the whole skill. You do not need a large emergency fund before you start investing. Some people build a full emergency fund first. Some people create a small buffer and begin investing simultaneously. There is no single correct approach, and it depends on the stability of your income. However, having zero financial cushion can turn minor setbacks into more significant problems. Step 2. Understand what you are actually going to buy, because this is where beginners often get confused and, frankly, where many of them can be misled. When most people picture investing, they imagine picking individual stocks. They study a company, buy its shares, watch stock prices fluctuate, and feel clever. And you can certainly do that. But here is the uncomfortable truth backed by decades of data. The overwhelming majority of professional investors, who dedicate full-time efforts with teams, terminals, and expensive research tools, fail to outperform the simple market average over the long run. If even professionals mostly cannot consistently predict stock movements, your chances of doing so in your spare time are not good. This is not an insult, it's just the empirical evidence. So what is the alternative? It is almost embarrassingly simple. Instead of trying to pick the winning company, you buy a tiny slice of all of them at once. This is what an index fund does. An index fund, or its close cousin, the exchange-traded fund ETF, bundles together hundreds or thousands of individual stocks or other assets. When you buy one share of a broad market index fund, you own a small part of a large cross-section of the economy in one move. Why does that matter for a small investor? 2 reasons. First, instant diversification. If any single company inside an index fund collapses, it only affects a small part of your overall investment, as you are not betting your future on one horse, but rather spreading your investments across many companies. Second, cost efficiency. And costs can be a silent killer that many investors overlook. Index funds typically have lower fees compared to actively managed funds, which can significantly impact long-term returns. Let us talk about that killer because it is important and it is invisible. Funds charge a fee expressed as a percentage per year, called the expense ratio. Broad index funds today commonly charge something tiny, like 0.03 to 0.2% a year. That means for every $1,000 invested, you pay somewhere between 30 cents and $2 annually. Some older or fancier funds charge 1% or more. That sounds trivial. It is not. Over 30 or 40 years, the difference between paying 0.05% and paying 1% can quietly eat a huge chunk of your final balance, because that fee comes out every single year and robs your compounding. So when you compare funds, that little number is one of the most important things on the whole page. Small fees. It is one of the few things in investing you can actually control. Step 3. Open the actual account. This is often the part where people imagine it to be more complicated than it actually is. You need a brokerage account. Think of it as a special account that lets you buy and hold investments. Opening one is usually free or low cost, can be done entirely online via your phone or computer, and typically takes about an hour to complete from start to finish. But before you just open a plain one, there's a smarter move for many people. Take advantage of any employer-sponsored retirement plans that offer matching contributions, effectively getting free money from the government or your employer to invest. These are tax-advantaged retirement accounts. In the United States, common ones include the Individual Retirement Account, IRA, and the Workplace 401(k). The details vary by country, so if you're not in the U.S., look up your local equivalent because almost every developed country has some version. These accounts offer a tax break for saving for retirement. In exchange for leaving the money until retirement, the government allows your investments to grow without being taxed along the way. And depending on the type of account, taxes are either deferred until withdrawal or avoided altogether during the contribution period. That tax break effectively increases your investment returns because it enhances the power of compounding over time. And here is the piece that makes people who understand it a little emotional. If you have a job with a 401(k) that offers a match, meaning your employer puts in money when you do, up to some limit. That match is an instant guaranteed return on your contribution, often 50 or 100%, before the market does anything at all. Passing up a full employer match is one of the only times in life someone hands you free money, and people walk right past it. If you have access to one, understanding how to take advantage of this benefit should be near the top of your list. For a beginner with very little money, the practical approach typically looks like this. Open an account, ideally a tax-advantaged one if you qualify and it aligns with your goals. Choose a low-cost, broad market index fund within it. The key to building wealth comes in step 4, consistently contributing small amounts of money over time through regular investments. Step 4, automate it and make it boring. This is the secret that isn't a secret. The single most powerful habit in investing is not brilliance, it is consistency. You set up an automatic transfer of whatever amount you can genuinely afford, whether it's $20, $50, or any other sum that doesn't strain your budget. And this money moves into your investments on a regular schedule without requiring constant thought. Every payday or every month, the process just happens. This approach does 2 things. First, it removes willpower from the equation, which can be unreliable. Second, it utilizes a quietly powerful effect called dollar-cost averaging. When you invest the same amount on a regular schedule, you automatically buy more shares when prices are low and fewer shares when prices are high. By doing this, you are not trying to time the market. Instead, you are simply showing up consistently. This consistent investing smooths out the ride by reducing the impact of volatility and prevents you from making panic decisions based on short-term market fluctuations. It is unglamorous. That is exactly why it works. Wealth building is supposed to be a steady, often boring process. If it feels exciting or like gambling, then you are likely taking on unnecessary risks. Now let me be straight with you about the risks, because a channel that only shows you the upside is a channel that is lying to you. Investing means your balance will go down sometimes. Not might. Will. There will be stretches where you put money in and watch it shrink and feel like a fool. The market has fallen by more than 30% during historical crashes, such as the 2008 financial crisis when it dropped over 50%, and it can happen again. That is the price of admission for those long-term returns. The returns exist precisely because you have to stomach the drops. But here is the context that matters. Historically, over long enough periods, broad markets have recovered from every crash so far and gone on to new highs. Nobody can promise the future will match the past, and I will not insult you by pretending otherwise. However, the pattern has been that people who got hurt permanently were often those who sold in panic and locked in losses. Those who kept their automatic contributions running and continued buying through difficult periods tended to come out ahead. Your worst enemy in investing is almost never the market itself. It is your own reaction to market fluctuations. A few honest guardrails before we close. Be extremely careful with anything promising guaranteed high returns, urgent action, or unsolicited advice from someone eager to help you invest. Real investing is slow, transparent, and often unexciting. If it feels like a countdown timer urging immediate action, walk away. Nobody legitimate requires you to act within the next 10 minutes. And keep it simple, especially at the start. You do not need to understand options or crypto derivatives or day trading charts to build real wealth. The vast majority of people who quietly become wealthy did it with low cost, diversified funds, consistent contributions, and decades of patience. The boring stuff is not just a beginner version that you graduate from. For most people, it is the entire answer. So let us put the whole map back together. 1. Clear high-interest debt and build an emergency fund so you are not forced to sell investments at the worst moment. 2. Understand that a broad, low-cost index fund lets you own a slice of many companies instead of betting on one company, and that fees can significantly erode returns over time. 3. Open an account and use tax-advantaged accounts like IRAs or 401(k)s, especially if your employer offers matching contributions, because this is essentially free money on top. 4. Automate a small regular contribution, keep it consistent, and do not touch it during market downturns. That is it. That is the machine. It is not complicated. It is just patient, and patience is something they cannot teach in a course. The reason so few people do this is not that it is hard. Rather, it feels slow in a world built on instant gratification. But that slowness is the point. The person who starts with $20 today and continues investing has already done the single most important thing. Start the clock. Everything else is about letting time work its magic. Quick reminder, this channel is financial education, not financial advice. Always do your own research and consult with a licensed professional for decisions about your money. This has been the Money Files.